Good morning, ladies and gentlemen. Welcome to this very early morning session here on the rise of robo-advisors and how they will enable the investment management's next era, or whether they actually will, and I think there's plenty to discuss this. We have about 1 hour. The clock is already ticking. That's quite something, 1 hour. If ever we get to the end and we realize we have exhausted the issue and we're feeling a little bit bored, I will chip in a few questions about the debate last night between Clinton and Trump. And just checking if you're awake. No, very good. No, I mean, obviously we can't go into politics, so if then I would start asking questions about Bruce Springsteen's upcoming autobiography, and we'll see what you think of that. In fact, no, 1 hour won't be enough, because actually I have the privilege of chairing here a panel of not only seasoned professionals, but very experienced people on this issue of robo-advisors. And let me get started by introducing them. Normally I would at this point say, let's start with the ladies, but we obviously have an issue there. Let's not dig into it, so let's do the sequencing here from my side to the other side. Matteo Cassina here on my left is the head of global sales and member of the global executive committee of Saxo. Saxo is a Danish online trading and investment bank, fully licensed and regulated, operating in 27 different countries. Matteo himself has extensive experience in investment banking with Goldman Sachs and Merrill Lynch. He also served as the president of Citadel Execution Services and has been involved, in fact, in fintech for more than 20 years. And as you can read on his official SIbos bio, he's convinced we are at tipping point and investing being significantly disrupted by technology. So plenty of areas we can discuss during this 1 hour. Next to him, we have Edward. Edward Glynn is with Calastone, Managing Director and Global Head of Relationship Management for Calastone, an independent cross-border transaction network for the mutual fund industry, and actually the largest such platform with the 60% market share in the UK. Is that correct? You will give us more on it afterwards. Edward has, like all the others, extensive experience. He's previously been with Swift, and before that with JP Morgan Funds Hub, Eri Bancaire, and has, among his many accomplishments, also helped to set up Luxembourg's FundSquare platform. Edward is, maybe that's also worth mentioning, very heavily involved in several charities. I think that in itself merits a mention. Then we have next to him Michael. Michael is Managing Director for Techfluence. Techfluence is a research, corporate and consulting development boutique, and based in Frankfurt and in London. Michael is also a senior advisor and a mentor at one of Germany's fintech community platforms, Fintech Forum, bringing together startups and investors. And Michael has extensive experience on both sides of the fence. So he will actually tell us more about that and how they at Techfluence and more importantly at Fintech Forum try to bring down the fence. He has worked for 15 years in asset management and investment banking for Commerzbank and DZ Bank in Germany. So also author of numerous fintech publications. And next to him we have one of the a founder here, a founder of Swanest. Swanest is a digital investment advisor based in Belgium and operating in London. Sylvain was co-founder and is the CEO of Swanest and has worked before in Zurich, Jakarta, and with the United Nations in Lebanon, if I'm not mistaken, and has studied in St. Gallen here in Switzerland. So just mentioned this to show his Swiss affiliation as well. He's dedicated through Swanest to putting people back at the heart of the financial services. Let's see afterwards what exactly that means when we come to it. And then last, but certainly not least, our friend Paolo Sironi from IBM. I don't think IBM needs much of an introduction, but I get very jealous when I see Paolo's official title at IBM. Namely, he's nothing less than thought leader. Thought leader for wealth management analytics. So Paolo in this role links fin and tech globally. And he himself was also a founder. He founded a fintech company in 2008 that provided goal-based investing solutions to wealth managers. And this fintech was then became part of IBM in an acquisition of one of its shareholders. Paolo is a recognized author of books about portfolio management and fintech innovation. And his last publication, Fintech Innovation from Robo-Adviser to Goal-Based Investing and Gamification. Paolo, you may hold it up. Good, ladies and gentlemen. Please, this is the panel, and we have about 54 minutes left to dig deep into the rise of robo-advisors. But first of all, let me answer the question, what exactly is robo-advisor? Obviously, I mean, there's a very simple definition, algorithm-based automated investment solution to conduct portfolio management. Good. I think everybody in this room probably knew that. Maybe let's start with Paolo. Let's discuss first what exactly is Robo-Advise, and then Michael will give us a little bit of a landscaping of where the industry presently is. And from there, let's kick off the discussion. But Paolo, maybe add something more to what, from a technical point of view, is Robo-Advise than this simple definition that everybody knows.
That's a very difficult question because there's no one size fits all, and as ever, when you talk about money and technology, things are not so simple. So they are automated investment solutions. It does not work on Twitter. That's why robo-advisors. They are not truly robo these days, and they are not fully advisors. That's also important. There's a lot of misconception and confusion in the marketplace these days. But basically, they attempt to engage the customers with a mechanism which is fairly digital or totally digital, which is an element of novelty in essence, because the onboarding of the customer wants to be most of the times very digital. So they need to create the right experience to engage individuals to like the idea of investing on the platform. And once you are onboarded, the idea is that, and I always say the idea because there's good and bad as ever, so we can also open up a discussion on the criticism. The idea is that you understand a lot more about your needs. So there's a bit of goal-based investing in place because you might have some buttons like I save for retirement, to buy a house, to do this and that. And therefore, it's like a self-assessment mechanism. And once you're inside, that's the beauty. Basically, you should take care of your money itself. So you don't have to care about it. But you should always care about your money. But there are things which are complex to do or tedious to do, like rebalancing, taking care of taxation, making sure that everything is in place and it is optimized. So they can create these elements that resolve a lot of administration techniques. But most of all, I think that they are helping individuals to start investing for the longer term, which is the typical proposition, while the rest of the industry has been focusing on the short term. The asset managers are using sentiment analytics, discontinuous trading to generate alpha, which is a miscalculation beta. Well, the robo is now asking you with a new narrative, which is more simplified on simple risk factors, to stay hold somehow and to let your investment go while the mechanism of rebalancing works and basically saves you butt, because it tries to modify your behavior, because most of us have been, it happened to me as well, to sell at high to buy at high and to sell at low. So this way you can avoid doing that. However, not always there is an algorithm behind it that does all of that. The asset allocation still relies upon theory. There are chief investment officers. They might not wear a tie, but a pair of sneakers, but at the very end, they do exactly the same job. That's why I say it is always about money, and you need to know and understand exactly how money is invested for your own wealth.
Good.
Health.
Thank you. What I forgot to mention before is that we will keep question and answers towards the end, but we will definitely set some time aside for your questions and have the panel answer it. But maybe now, Michael, if you could give us a little overview of where the market is today, who are the big players, and then we'll kick off the discussion from there.
Yeah, thank you very much, Nicholas. Good morning, everybody. Maybe I'd add to what you mentioned kindly before that I also was in the startup myself after 10 years in banking, 3 years in the startup. That's why he said I know both sides of the fence. Where does the industry, the Robo-Adviser industry, stand at the moment? It stands exactly at $60 billion US, which sounds like nothing. But the growth has been tremendous over the past years. I think when I was interviewed for today's issue of the SIbos newspaper, it was still 50. So now we've seen figures of 60 billion. Betterment is the biggest player at the moment. We've seen the founder, John, yesterday on stage here. They rose basically between probably 2 months ago from 5 billion to now 6 billion. Overall, one must say that the robo industry seems to be concentrated very much in the US. Probably 90% of the assets are there, with Betterment being the biggest startup. Very impressive story, but Vanguard and Charles Schwab being the big fishes here. And this is sort of coming over the pond now into the old world. Already 5-6 years ago, we count now in Europe 50, just about 50 robo-advisors, 52 or 53, depending on how you count. Major markets are Germany with the biggest number of robo-advisors. Second largest is UK, where I think there are 10 to 12, most of them in London. But the biggest European robo-advisor actually is based in Spain, roughly $1 billion assets under management, a company called Field Capital. Many of the robo-advisors, unfortunately, don't publish their AUMs. That's different in the US. The European ones are keeping rather calm. One figure that the founder authorized me to mention is 100 million by Money Farm. My gut feeling is that a few others are close to that big figure, but that will be published then when the time is right. We have seen quite a number of deals recently. I think what happened there was that Betterment and Wealthfront basically, when they crossed the 1 billion, some guys woke up because a billion is not small change even to big asset managers. They saw this coming. And social trends, obviously, that drive the robo-advisor industry. And they started looking. So BlackRock started obviously acquiring Future Advisor last year. There were some smaller deals. Deutsche Bank started cooperating with German robo-advisor. We've seen yesterday the news that Allianz bought a share at Money Farm from Italy. This is ongoing. And why is that the case? If you look a bit into the future, there are quite impressive estimations of where the travel of this industry goes. I think I need to look into my notes to give you the right figures. I will start with the lowest one. So that's a projection of Cerulli now, which I've probably half a year old, $480 billion US by 2020. My private banking research estimates 1.6 trillion by 2020. Trillion. A.T. Kearney, 2.2. And the last one, which I only found this morning, actually it's the Financial Times estimating 16 trillion by 2025. So this is where the estimates go, and these are not fintech romantics who is giving these numbers. I think for the moment I would leave with this.
Thank you very much, Michael. What I would like to do now is first take apart a little bit what Mike, not apart in a contentious sense, but dig deeper into the picture that Michael has given us of the industry as it stands, and then in a second step only look into where this is actually going. So maybe if I can bring in either of the three online guys, I mean, those that actually are working with robo-advisory, what do you say about the market as it stands? Maybe also, why is it that the US is so much further ahead? They had a head start, but why is Europe slow in catching up? Why is the rest of the world even slower?
I mean, in general, I like to catch that question. In general, it sounds as if the industry is growing. It sounds as if there is a little revolution in the wealth management industry. But what I think is still fair to keep in mind is that it's not all rosy. You know, as a startup, we quickly realized that actually in this industry there are huge difficulties that you face with these kind of businesses, and one that some of you may know is tremendous high acquisition costs that you face in order to obtain new customers on your platforms. And if you keep in mind that you need to spend hundreds and hundreds of euros in order to obtain customers that are going to generate even below 100 euros of revenues a year, then this industry doesn't look that successful. So maybe, yes, in America it has been growing faster. They have been there longer. Betterment, Wealthfront, they've been there with substantial amount of funding. They have been pouring money into marketing like hell. This is why they're growing fast. In Europe, I think startups don't want to share their figures because they're not growing fast. I think product market fit is still to be elaborated. I don't necessarily think that lots of business models out there at the moment are the perfect type of product for this segment of customers. I think there is still a lot of customer understanding to be done in order to develop a solution that really fits the needs of these digital investors.
Yeah, I'd like to
Edward.
also, I think it's very important to take figures with a slight pinch of salt. I think it was Sally Krawcheck who famously said, and I put this at you with your growth figures, but Sally Krawcheck was famous for saying that what everyone thought was growth was actually just increased risk wrapped in complexity and riding volatility. And so if I look at the industry, I think over the past 15 years, and we talk to some of the 1,000 or so institutional clients that we have today, I think it's very difficult to segment exactly what is robo-advisory and what is straightforward distribution. And I was involved in a startup some 15 years ago, which we ended up selling to JP Morgan. And in preparation for this, apart from talking to some of our clients, I looked back at the presentations that we gave 15 years ago. And the one that really struck me was we were talking to a group of advisors and private bankers, and we were talking about what do they look for in a platform. And it was very simple. These advisors and private bankers were simply looking for the capability to answer 4 key questions for their clients. What do I own? How's it doing? What shall I do next? And can I do it now? And if you were to look at what a basic robo-advisor, which I hate that term, and I think we should actually just ban it, but if you look at what these guys are actually providing or looking at providing today, it's really not that much more in its simplistic term than those 4 key questions. So I'm interested to know as well, when you segment the market and you look at that growth, who do you put as a platform, a supermarket, a robo-advisor, and how do you actually segment between them? And I tell you why I ask that, because 60 to 65% of all of the fund assets are being traded or are being powered by Calastone technology in the UK. And if you were to say to me, who's a platform, a wrap, a robo-advisor, what do you class Hargreaves Lansdown, what do you class co-funds, some of our biggest clients, I think it would be very difficult to segment.
Do you mind if I go back 1 second to the question you asked on Europe-US? I've been involved in European and American online brokers for the last 20 years. And I'd like to step back a little to the late 90s, where the first digital revolution happened, the online brokers, where the dream of you can do it yourself, you get the tools, and you can become self-empowered to manage your own assets happened. All of them were fintech startups. They were, .com. They were with a website, and no one had a website before. And what happened in Europe in the late 90s is that a number of organizations, the Consors, the Direct Anlage Bank, the Fineco, the Bank Inter in Spain, the TD, E-Trade, some of the Americans that came over to the UK mainly, spent a very, very substantial amount of marketing money to acquire customers. Then that world imploded a little because there was a bit of overcapacity and the fees went down and the volume never exploded. And there are a number of players that found themselves, everyone virtually, apart from a couple that made cross-border acquisition, but they even kept the same branding, the Cortal Consorts of this world. No one managed to go cross-border. Everyone remained, the top 5 in every market is local. And so when we draw a parallel US and Europe, US has a massive economies of scale advantage. There's a market which is very uniform that created a consolidation that left 5 players. People that came from trading, the E-Trade and the TD of this world, people that came from funds, the Fidelity and the Vanguard, Schwab probably been in the middle, but all of them competing in a market that is very substantial and normalized. That, in my opinion, pushed some of the investors, the venture capitalists and the Palo Alto investors to actually put a very substantial amount of money into some robo-advisors in the US that spent, again, very significant sums to acquire that the first $1 billion. In Europe, because the market is so fragmented from a product point of view, from a tax point of view, from a culture point of view, the brand, and I do bank in France with a French bank, no one yet came to a robo-advisor in a specific country with $200 million of marketing money for them to create those economies of scale. And that is a challenge, and I don't see Europe becoming one unified market for a long time. And so the local champion, where you charge 30 basis points or free, Schwab launched it for free, to attract 1 million customers to eventually then sell something else to make some money out of those 1 million customers in one market alone is a very, very, very challenging proposition for an investor.
Okay. Maybe if we leave the US-Europe comparison and look... Sorry, Silva.
Even though, I would like to add one major aspect why the US is growing much faster, and I think we tend to forget it. Money moves way easier in the US. Like in the US, back-end providers, they have already made APIs to which startups can easily connect to. If you go to Betterment, in a couple of minutes, you have transferred your entire pension. This is at the moment not feasible in Europe. So there's a huge demand in efficient backend infrastructures that can actually supply all these front-end providers and that enable to make money move quickly. And I also think this is a very interesting part for banks and established players to jump in and actually to provide this efficiency.
Can I just ask you, what efficiency do you think we're lacking? And by the way, I ask this as a completely loaded question. I'm looking at Paolo as well, and I desperately don't want to kind of fight with Paolo because he's written a book on this. So Paolo's the man in this.
Can hit you.
But when you say we don't have the efficiency, and I go purely from a Calastone perspective and my own involvement in this industry for 15 years, which has all been around the streamlining of the asset management and distribution supply chain. We power 65% of distribution today with nobody touching anything. And that's not just the order into the funds. That can involve all the reporting, the reconciliation, the settlement side as well, all the way down to data that looks after the end distributor. So I'd love to know what we have to fix this year to come back and for you to say that we don't have it.
This one particular efficiency problem I was referring to is that I can, with a couple of clicks, transfer my pension from Credit Suisse to a online investment platform to take money from my UBS account within a couple of clicks without opening any other accounts and move it to another account. The best would even be if I can leave it at these institutions. I mean, that would be the optimal case. No front-end platform necessarily wants to move money, but at the moment, most robo-advisors need to, because traditional banks and financial service providers, they don't have APIs through which you can connect. They don't necessarily want to at this moment, because you might take some of their market share, this investment advisory part, but you can still leave them the custody and brokerage part. But at the moment you cannot. So you cannot easily switch money, and that creates a huge burden. If you look from a startup perspective, if someone have on your page 100 people coming, even if you have an easy process, you lose customers still maybe 5 people, put their email address, open an account. But then the burden begins, then you have like these huge formulas trying to make you compliant through all the MiFID process, and then you have to open an account, and at the end, the amount of people that are going to create an account with you, move the money, it's very thin.
So it's not a technical problem, it's a regulatory framework.
So that is really water to my meal, but not to my answer, but to my question to our friends in the audience. I have the chance of seeing many constituencies from Asia to the US. They're all very different. The structure of the industry is different. Way many more independent financial advisors in the UK, in the US, in Australia than in core Europe, for example. But there are 3 big drivers or mega trends that are creating transformation in the wealth management industry, for the good and for the bad. One is technology. The second one is the generational shift, so the millennials and the baby boomers. And the third one is regulation. Now, raise the hand, he who thinks that technology is the main driver to transform the wealth management industry today towards 2020.
I mean, raise your hand if you think. That's not very much.
Okay. Raise the hand who believes that is about the generational shift, so the millennials having a different behavior compared to the baby boomers. I also need to turn here. My best profile is the right one. There are more people here, but I see. So raise the hand who thinks it's regulation creating innovation in the industry. It seems that people have been reading my book or my post on LinkedIn, because effectively it is regulation. The reason it's regulation is because in Europe, the MiFID has not started yet. In the US, started before the RDR in the UK. So it's basically transforming the industry from a packaging mechanism of product into a packaging mechanism of advice. And the two things are very different. It's shrinking the distance between the product makers, the asset managers, and the final customers. But selling advice is not the same thing, because you need to ask the client to pay for that. So only when the framework is transparent, then you can provide a compelling proposition. And then it's a push industry. Clients don't really and don't usually understand. So the moment the regulation raises the fiduciary standards, the whole industry is forced to change. And if you don't change, if you don't become more transparent and more independent, the cost of compliance will keep on soaring. And that's why robo-advisors are showcasing that it is possible to create a new business model that banks can embrace in order to fit with the new regulatory framework. Nothing happens in one day. Of course, today we have technology that we didn't have before. Internet is everywhere. They're taking movies with the iPhone. We have a cognitive to create automation, to create and to build different narratives. So to come up with efficiencies. But the key element here is that what banks are selling tomorrow in 2020 is going to be different, and the way they're going to be paid for that is going to be different.
Let me ask a question on that last part. The end game, the outcome of this is probably, as we already see, disintermediation. How is this disintermediation affecting the current business model of many of the distribution platforms? I don't know, Michael, maybe you can come in on that.
I would like to say that what Paolo already mentioned, that we have different time. Technology now is much more powerful, because you mentioned end of the 90s. There's much more you can do. And I think people also remember in the industry, and also the founders know what happened there. So I think they're much more cautious. And one driver we have not mentioned is interest rate. We had a different interest rate level in the end of the 90s. Now we have no interest rate. And people start suddenly seeing that 1% can be a lot of money, especially for, let's say, the wealthier people. And if you combine this cocktail of the three factors you mentioned, I think we will see a shift from once the analog world is shrinking, we go more into the older generations, go more into the digital world, that there will be a shift into simply cheaper asset classes. It's better to be invested than not to be invested, and then you choose a cheaper or maybe even the cheapest option. Whether that's the best one, no. But I think this is one of the big drivers, and this is why startups went into this, seeing this development earlier than corporates. We strongly believe that corporate innovation is very difficult. We believe a lot in startup innovation. That's why we bring startups as TechFluence and FinTech Forum into corporates to help them innovate and see certain things maybe earlier. Now I have not answered your question, I believe.
That's a very good way. But maybe Matteo, where do you see disintermediation leading this?
I think for me, if I think in disintermediation of financial actors, I don't see a major change. There's still going to be the custodians holding the assets, the brokers transacting, the banks holding the relationship with the customers and attracting them. I think if there is one player in this equation that will be, in my opinion, disrupted and disintermediated is the private banker.
Okay, but if everything remains the same, if we keep the custodians, if we keep all the different players, and if the overall environment, as Michael also hinted, remains a low interest rate environment, thus low returns, where exactly is the advantage of the Robo-Adviser? Where is he better than the traditional advisor?
I think for me where it's better is that technology can do a much better work than a person, in my opinion. So I think about my own experience. I walk into a branch, I'm in my 40s, I have a child, I need to pay for university, I have a house in a different country, and I start asking my private banker, what's your view on the currency, the Swiss franc, because I have a house in Switzerland, what's your view on interest rate, what's your view on that stock that I bought when I worked in Singapore 15 years ago. They just don't have the answers, and everything that is produced by the Goldman Sachs of this world or the Fidelity is digitally available, is on the platform, and I think if you match the customer goals and behaviors with all of the data that banks know that they never took advantage of, and you match it and you actually answer back to the customer on a very, very engaging user experience, then in many cases, apart from a complex, I need to set up a family trust, I need to manage my tax and my inheritance, but a simple investment decision on do I buy this fund versus this, digitally, the experience will be much more engaging and much cheaper, and hopefully instead of paying a person, the technology will be scalable, and the delta between what I would pay to a private banker to what I need to pay to that platform is a compounded return that would make me retire with quadruple the money 30, 40 years later.
Okay. Edward, where do you see the advantage? And let's get the others then involved as well.
Your initial question was around disintermediation.
Yeah.
I don't personally see that disintermediation is the key point here with regards to the advisor community. I think that with advent of new client-centric disruptive technology is a great catalyst for the industry as a whole to professionalize even further the advice segment. And I remember pre-RDR in the UK, we had 28,500 IFAs, the average age of whom was 54.5 years old, and he'd been pretty much a door-to-door insurance salesman flogging a product in order to get a high commission. We're not in that world, though, anymore. And I think that the particular tools that we're talking about, sure, people find them perhaps slightly scary, and we're starting to see a marketplace now that we had in the 80s, whereby banks started buying up estate agencies in order to have a captive distribution channel for mortgages. And we're starting to see asset managers who are very, very concerned with regards to their future distribution chain, and therefore they're buying up distributors or robo-advisory firms. But I think if we get this right as an industry, we're then in a situation where people have choice, and choice is really important. Some people want to interact with an individual. Somebody just said on the panel that it's all possible to do it online. I fundamentally disagree that that is currently available. If I was to call up a pension scheme from an old employer 10 years ago, forget the fact that it's not online, they wouldn't even be able to send me a statement in 6 weeks. So I think we have to use these new technologies and new channels to provide choice back to the end investor and to dramatically reduce the cost of the overall investment management and distribution supply chain. And technology can drive down cost, and that's what I think. Cost, risk, better choice, better service. That's what we need to be aiming at.
Sylvain.
Yeah, maybe to add to that, what's the advantage of robo-advisory? Where I see it is that you become capable of providing much more quality and personalized investment advice in a much more simple way to the mass. I mean, when you go to a bank nowadays and you want to invest 10, 15, 20, 50,000, I mean, have you ever walked to a branch and asking them about investment advice? What you're going to get is a little paper telling you, look, here you have a high risk, a medium risk, and a low risk fund. Please make your choice. We're going to invest your money for you. I mean, that's not personalized at all, you know. People, especially millennials, they have their beliefs. Maybe they like companies, Tesla, Apple, 3D printing they love. Maybe they want to plan with it. They want to understand their investments. Where is my money? Where does it make an impact? How much do I pay? How is it going? Is this really the best way to invest my money? All that they don't get. They get this little sheet with 3 funds. And this is where I see the importance of robo-advice.
Can I just agree with that point, though, because we've talked thus far about relatively developed markets. So obviously, if you're in a developed market, you might have a lot of money, both as an income, as an asset base. You might have a complex tax situation. You need estate planning. You need help, etc. But if we look at a more developing country, I was looking at this the other day. One of our biggest clients within continental Europe is actually in the Czech Republic. And to be able to provide an infrastructure to those guys who have perhaps 200,000 clients, each of whom are saving, again, maybe the equivalent of 20 to 50 euros a month. This is a new generation of people who are starting to save, who have access to technology. And I really absolutely agree with you that in that kind of environment, a very simple online tool with to access with a basket of ETF, simple portfolio, easy to understand, easy to access, great advice, is a fantastic tool to get that next generation of savers saving.
I absolutely agree on this one. Internet basically gives access to the long tail. But you mentioned choice, give people choice. If you give, especially private banking clients, also the choice of robo-advice, and they see that it's a lot cheaper and it's a lot more sophisticated. Because what you mentioned, going to your private banker, what your private banker does not know is what have you been doing online in the past few days. Ideally, he would know your wishes before you know them yourself. And that's the power of technology. And this needs to be integrated. And I think that the best prospects are with those institutions that have already a brand out there nowadays, ideally a good brand. And if they implement the modern technology, maybe with the help of startups, then they will clearly be the winners. This is where the growth is. But startups have been doing their job. They've been basically innovating. They've been proven to be more agile, and they're destroying a profit market at the moment.
Let me pick up on that point, Matteo. You said before that maybe the one actor in this field that might be disrupted, if I may say so, is the private banker. Don't you see I mean, over a year ago, we were discussing a lot about disruption, the incumbents not working together. Over the course of the last year, we saw a lot more cooperation between incumbents and startups. And it has been mentioned both by Edward and now by Michael that actually you see a lot of the traditional actors starting to work together with startups, with creative people to help them keep track of this. Isn't the private banker or the traditional asset manager also now looking at leveraging these solutions in order to develop an internal solution that will make sure that the client remains?
Absolutely. So I think for me, the one thing that needs to be mentioned, I do not agree 100% with the view on the solution is for $50 a month. If a customer pays 10, 20 basis points a year on $100,000 of assets or on $500,000 of assets, there's no ability for a bank to pay a competent and skilled private banker in the middle to be able to be scalable and cover 50 clients or 100 clients. So technology will empower potentially a relationship banker, that combination between a digital acquisition and a personal acquisition, and a relationship that also gives the trust of meeting a real person and having a conversation. And so I think technology will make, and is making, we have, as a bank, we have probably 50 white label relationship with financial advisors that whose private bank as a financial advisor with the power of attorney manage money on behalf of their clients, sometimes totally, sometimes partially. But I think what's key is for them to be digitally scalable, to be able to cover many more clients, to be much more competent in the way they give them personalized signals, digital, based on their individual situation and their individual portfolio. So the technology can identify, I'm 45, I used to have a 5,000 euros income every month. The last 3 months I haven't got any income, probably I lost my job. My son started university, I have 2,000 euros a month for university. The stock that I hold, the Tesla, went down 22% last month. I have a mortgage payment that I need to redo next month. And all of that, only with technology you can actually manage if you have 1,000 clients behind you. And I think the one thing that has happened today is that my mother, as an example, she's 75, she's never opened a computer in her life, she has an iPad, and she's banking with the iPad because she doesn't even need to remember the password because she puts the fingertips. So the reality is she's not trading options on the iPad, but the reality is for the first time in 35 years, she can actually go like this and say, the shares in Banca Popolare di Verona that my father left me, this is what they did the last 30 years. I've never looked at it. And so for me, I think the ability to digitally understand what your money is doing for you and understand how far you are from the goals of paying off your mortgage, paying the university to your children, retire, and how much money are you going to have when you retire and how long it's going to last based on the spending pattern, only with a visual tool that today with an iPad is very, very easy. You can do it. And I think the problem with the traditional private banks, they haven't digitalized that well enough to be transparent and to actually provide the digital experience of the view on my account, not really on doing transactions, but it's, do I understand what's happening with my money? And I think to take the biggest example is employees' pension schemes. I get my statement once a year. I don't understand what it is. I don't understand where I put the money if I have an employment for 10 years with a company, what happened to my portfolio and whether there's other places where I should put my money. And I think it's a shame because I find myself 30 years later where I could have double the money. If only I had an engaging platform to look at, and sometimes I switch country, I switch asset, I switch sectors, because I had a view, but I never connected to my...
Can I add to Matteo's comment on private banking? Because retail banks and private banks, ultimately, they own the customer. And we know that it's valuable because we heard that acquiring new customers is expensive. It's not so easy just because you're digital or you're fancy. Even a nice UX can be easily commoditized. On the other side of the industry, you have the asset managers they could control the distribution channels because of the retrocessions. So basically, they could incentivize some channels on the open architecture to sell their products instead of other products. Now, the moment regulation changes this mechanism, so modifies in deep the way the money is exchanged between the parties, then is where transformation happens. But the private bankers might be transformed more than disrupted because they own the customers. The problem is with the asset managers. Interest rates are 0 to negative. Passive investing seems to be better than active investing because they cannot justify it. So they will have to shrink or aggregate. They will have to automatize. Now you can do machine learning to generate portfolios, rule-based algorithms, so on and so forth. So the biggest transformation in 2020 or 2025 might not be at the level of the conversation with the customer, yet more digital, but will be at the level of the asset managers. And you know why? Because, as we said, the robo-advisors are not selling products. They're selling portfolios. It is very different. The narrative around that is different. Portfolios can go around the need of individuals more than products in the way you position it. And that's when you start tiering your customers, not in the classical way, like the rich, the middle, and the poor, so I give them a different solution. But do you have a need? If it is convenient, you line up yourself. The robo-advisors, we were speaking yesterday again with John Stein, yes, they were born to appeal to the millennials and to the retail customers. In the reality, the affluent people started onboarding on the robo-advisor. And when I was working in banking, at the beginning of 2000, the bank was already discussing how to roll people's money and portfolios to capture more business. It was a transaction-based business because there were so many banks, difficult to acquire new customers, even for a bank. Then there was the financial crisis, I'm done. So no innovation, all integration. 10 years after, here the robo-advisors come, and they put exactly in the pocket of the banks, the affluent people. And that's when the debate started and was ignited in 2015 and became what it is today on the fintech scene.
Thank you. You mentioned before 2025. Maybe I can ask, after you've given us your view, the others, where do you see the wealth management and asset management industry in 2025? Where's this going? Briefly, and then we go over to Q&A. Matteo.
I think it will be very digital. I think it will change the pattern on how people save, going back to there is a future and there's no pension for me. And I think it will change people behavior. But I do not see substantially the major actor today not being around. I see a few making it from
Do you see
startup.
new actors?
I don't see many. I think the incumbents are still very profitable and very big, and eventually they're watching from afar. They have a very profitable business. They're not stupid at all, and eventually they will acquire them and make them part of what they do, and the industry will transform itself. But I don't see the old banks closing down and going. And
Edward, do you agree with that? Calastone, isn't that an example of the success?
Thank you. Absolutely. Let's finish there.
You pay me that beer.
80% of new business being written on the new online platforms and robo-advisors is apparently from new investors. And therefore, collectively, we have a duty of care to get that generation saving. Currently, in my own home market of the UK, 34% of households have less than £250 in savings, 50% have less than £1,500 in savings. And actually, if you look at house prices for the under 35s, you're often in a case where it's at 10 times earnings. The scary thing, though, is that the trend for successive generations to earn more than their parents reversed 5 years ago. And so your question of how I see things in 2025, hopefully we will have seen some consolidation that has been on the tipping point for many years, but we haven't really started to see. We will see the generation who currently have a lot of money, who are being serviced, I suppose that will start to peter out as they start to leave this world for the next. But I think we will have a whole host of new, young, tech-savvy investors who will have access to much better tools, much better advice, and a better technology framework that means that they can access all of that, get predictable outcomes for very low cost. The thing I'm worried about, though, is that actually if you look at various studies, we see that it's the older generation who have better education with regards to financial services. I laugh at the example of your mother trading options, but I think that if you believe the studies, that the older generation do have a better level of financial education than the younger generation. And so what I don't want to happen is that we have a whole load of very tech-savvy teenagers who have access to great technology, but who have no understanding of the concept of delayed gratification, which means simply that they're uneducated, but have access very easily to very good tools to make very stupid decisions very quickly that you can't unwind.
That's not the case only in finances. As we could see, I had to bring it in. I mean, for those who weren't here in the during the introduction. Sorry. Michael, you gave us some figures in the introduction. Where do you see the wealth management and asset management industry in 2025? Briefly.
2025 is a very long time.
No.
Now 1 year is already pretty hard to predict. Currently, we see around 250 robo-advisors worldwide. I think we're going to see many more. Last year I said we will see a tenfold growth. That's probably, especially if you include China, will happen, simply because they can operate on a much lower cost base. And they will drive very many things like complete cost-free services, monetization through other channels, and so on. We will see non-financial players coming into the financial world because brand is even more important in the digital world than it's nowadays. I do see some existing brands disappearing. I do see some few, as you, brands coming new onto this scene. I see a big problem at the asset manager level because they're not transforming at the moment. We see the banking transforming, we see the insurances transforming, but the asset managers who have lower contract cycles are basically, they don't see the need because they still have a lot of assets at the moment. They save a bit on trailer fees by now, and there will be their inflows because of the interest rates. So the immediate need is not visible to the management. So I see a problem arising there. If they don't do something, then there will be a problem. There's one German asset manager, Union Investment, one of the biggest, who did a Robo-Adviser as a.
Well, there are many other examples. I mean, we in Luxembourg see it took some time for the asset management industry to wake up to this, but I think they are very, very fast catching up. And if you look at only JP Morgan, BlackRock, Vanguard, Fidelity, all of these are now working together with startups. But
it's still 5:30 in the morning, something like this, so a long way.
They're catching up fast. But Sylvain, what?
Maybe to focus on the platform view, 3 points. One major point is evolution. I mean, nowadays I see a lot of startups doing the same. Robo-advisory platform, I don't think it's a perfect product market fit. There are different digital investors. They need to adapt to their needs. So there must be evolution in the platform. Evolution going to go towards personalization because investing advice is highly complex and it's very personal, and platforms need to become able to deliver more personalization. If they become able to personalize more investment advice, they will gather lots more data of customers, which then going to move towards machine learning and eventually artificial intelligence to be able to deliver even more personalized investment advice.
Yeah.
Can I just give
you
my
started
prediction?
the round.
No, but I like this one.
We need to keep more time also for the Q&A, but briefly.
2025, I will be here with you at SIbos. I will be writing books you can read in 3D, but I will be talking to cognitive machines.
Good. Ladies and gentlemen, I said before that we were going to put some time aside for questions. We have 6 minutes left. So who wants to kick off? We have microphones, and I would be very grateful if you could introduce yourself with name and affiliation, and then keep it to one short question, preferably directed at one. If you don't do that, I will distribute the question. The lady there.
I'm Effie Pilarino with Daily FinTech.
At least we can start with ladies in the
Exactly. So I want to ask about performance. You spoke about robo-advisors. We all agree cost and onboarding and client service and customization, but why aren't we hearing about performance? At the end of the day, this is about investing. We all want good performance. Fees are part of that, but why isn't the industry showing the performance? I don't care about the assets that you manage. I care about whether you can deliver performance.
So that was not directed to anybody in particular, but maybe let's take the banker here, and then the asset manager. Very quick compliment.
It's a dream I had for many, many years, and I think I was naive to think that lowering the fees and showing a better performance would drag people to move money. I don't think it's going to happen. I think it's going to be marketing a user experience and not the absolute performance of one player versus another, because all of them will have multiple portfolios in different scenarios. You can invest in Asia, in renewable energy, and it's your own decision. There is a benchmark, and they're going to show all kind of portfolios, and I don't think the money will move based on absolute performance, unfortunately.
Good. Edward, do you have anything to add as an asset manager?
I remember post the crisis in 2008, there was a great PricewaterhouseCoopers survey that talked about why did people leave their product provider, their asset manager. And overall, an enormous majority of people leave because of poor service, actually, not because of poor performance. At Calastone now, we are representing and powering the distribution of 1,000 players, 29 countries, maybe half in distribution, half in asset management. So it's not really for me to talk about the individual performance of individual firms. But what I will say is this, and this has been, if you like, our personal mantra since inception and my own personal mantra for 15 years, which is the greatest contributor to alpha is cost reduction. And that is our job here in the industry, is to allow all these players to play together nicely in a very low cost, very low risk environment, and then you will get your performance.
Good.
One very brief answer.
Very brief.
80% of the actively managed funds do not beat their benchmark, i.e. over a long time. Lipper publishes this figure since years. It almost doesn't change. Right. They should not be in the market. That's how important performance is.
Sorry, we have another question. The gentleman in the second row.
Yeah, I'm Rashdi from Abu Dhabi Investment Authority. I raised my hand first, but you did a good job. Ladies as first, always. In fact, that I have the same question. I mean, performance, as an investor, I will always look for historical records of any platform and how it's been doing. So in the absence of any performance record, I don't think, and this might contribute to the slow of this robo-advisory, if in the absence of really evidence of how this is performing, I wouldn't be encouraged to invest or to put my money.
What is the question?
So that's the question. The question is what she asked.
So it's a comment.
Yeah,
Can I add?
Sorry, gentleman in the first row.
A very quick question. I just wondering, who are the players?
You are?
My name is Robert Stewart from Eurofema. My question is, what's happening at the corporate level? Who are the advisors for the corporate treasurer who has some funds to manage and wants some robo-advice?
Good. Paolo and Sylvain. and anybody else who wants to chip in. We have a minute and a half. So
well, in reality, it's really about robot technology more than Robo-Adviser. And so the way forward is really to provide services to institutionals that can either service their needs or service their customer respectively. So a lot of solution may be there. It's just that a lot of money is funneled in the VC world towards the B2C model for retailers because it's fancy and it catches the headlines basically. So things go under the hook. But the future is really for planning and advice to get together. And planning is already more asset liability management. And you can come up with solutions that operate well on digital and are convenient. And that is when it's going to map the institutional needs that you are referring to.
Good. Anybody wants to chip into that? If not, then, ladies and gentlemen, we are in the process of running out of time. And as I told you, 1 hour is hardly enough to scratch the surface of this very, very interesting topic, and on which I think our panelists have shown that each of them individually, but also collectively, have a lot to bring to the issue. We look forward to being here in 2025 with Paolo. And ladies and gentlemen, please, a round of applause for this extraordinary panel.